Well, good afternoon, everyone. This is a webinar on the California Municipal Fiscal Health Diagnostic Tool. Today is September 4th, 2013. My name is Don Marusk, and I serve as the Director of the CSMFO Coaching Program and as moderator for this session. We're delighted to have so many locations involved. There are over 100 participating already, and we've had 200 registers, so we think more will be coming on very shortly. This is the 15th year of the coaching program as a member benefit, and the Career Development Committee guides these sessions and was very interested in having the opportunity for CSMFO members to learn about this new fiscal health tool and to have that information in advance of when this gets presented at the annual conference for the League of California Cities, so that you're ahead of your city manager and elected officials and others that might be at that session and able to respond to their questions and know what this tool is about. So just as a quick overview, these are some of the topics that are going to be discussed today so that you can get a sense of how this tool fits in with other things and other ways that you evaluate your fiscal health and how it can be useful to you and your elected officials and your communities in understanding fiscal health and how to approach it. Michael Coleman's going to be presenting this. He's well known, of course, to CSMFO as a fiscal policy advisor, not only for the League of California Cities, but also for CSMFO. And we've asked Ron Bates, who's the city manager in Pico Rivera and a past president of the League of California Cities, someone who's rolled up his sleeves and gotten involved in understanding this tool, to be a commentator for you for what this means for local governments and how to use these topics and information effectively. So that's our plan, and we encourage your questions along the way. I'll be breaking for questions at various times, and if you use the question function on the webinar, I'll be able to pick those up and direct them to Michael or to Ron at the appropriate times. We do have our very first polling question. Again, if you're seeking to get CPE credits as a CSMFO member for your CPA license, you'll need to respond to 5 of the 6 polling questions that we'll have today. So the first one here is we want to get a read on who's attending. So we are going to invite you to tell us a little bit about who's in your group, and so we know what perspective you're bringing to this session and able to respond appropriately to the needs and interests that you may have. And while we're doing that, I just again want to encourage you to know that all these materials will be available on the website for you. We're also doing an integrated audio and video version of this. It'll be available on the YouTube channel for CSMFO Coaching so that you can share this with others and they can get something of the experience you've had today, although without the opportunity to give the direct feedback and questioning of Michael and of Ron that's available with this session. So we're going to give a moment or two more for you to respond to this initial question here and take a look at who our audience is so that we can serve you in the best way possible. And here we go. So we can see, as expected, the majority of you are senior local agency finance professionals. Some of you are up and coming in your local agency finance group. Other agency executives or general management are involved, and other finance professionals. So we have a good mix here today. I think the kind of mix that Michael and Ron were hoping to see in today's session. So just before we begin, we've asked Ron Bates to just make a comment to you about the context of this work and why this is important for general managers and for finance professionals to know about. So Ron, if you'd share a comment or two about that.
Sure, Don. In viewing this particular tool, I think it's valuable to all cities throughout the country, especially here in California. But my rationale is this, is that I see this as a time of exceeding financial challenges for cities. When I look at the future over the next 10 years, I honestly see the number of cities that are going to be in severe financial challenge. increasing pretty dramatically. I also chaired the City Managers Pension Reform Committee here in California, and I can just tell you the increases coming from PERS. We know already about a 50% increase for miscellaneous employees that's already been put into the mix. And coming next year, we'll be looking at additional costs for a redo of the longevity tables, and also a change probably of 0.25% in the discount rate, which will also further impact your rates for both miscellaneous and public safety employees. Combining that with all the challenges that we're facing with Obamacare and the impact on healthcare costs for those of us that pick up the full costs or a large portion of the costs for medical benefits and medical retirement, I think those things in combination pose a huge fiscal threat to local governments. I think this diagnostic tool will help you get a handle on where you are right now and then be able to take a better look at where you'll be in the future. So those are some of my thoughts, Don, on why I think this tool is valuable for all cities to begin looking at today.
Okay, great. And we also want to highlight that this is a tool that can be used by counties, special agencies, special districts, et cetera, so it's not just limited to cities. And we now turn it over to Michael Coleman. Michael, thank you so much for all the work you've done in preparing this and preparing today's session so that this can be of special value to members.
My pleasure. Good afternoon, everybody. It goes without saying that in our world of financing local government services, we've been going through a very challenging time. We've been through a protracted economic downturn that only now we are gradually recovering from. We've had continuing threats to our finances from state legislative actions, most recently the dissolution of redevelopment and the capricious taking of the remainder of City of VLF funds. We've had sales tax revenues, gas tax revenues in flux as our old rules grow out of step with changes in society and the economy. And many of us have huge looming unfunded liabilities for pensions and other retirement benefits, and our current employee compensation packages, especially in police and fire, increases in the future that are not sustainable. In recent years, these and other factors have brought this to a critical head in many localities, as you know, where they simply could not make their financial commitments and had to pursue bankruptcy. And through all of this, we got questions at the League and elsewhere from our constituents, from the media, from creditors, from employee associations, taxpayers, city council members, city managers. You got them too. Who is next? How is our agency doing? And we get state officials piling on and running in with the story to suit their own purposes with audits and pronouncements. So where we were getting inquiries at the League, especially from mayors and council members, as to what questions should I be asking? And from city managers, what's a good tool that will help me answer those questions sufficiently and with some credibility? And that was the genesis of this project. We've been working on this for many months now. It's already been through many refinements and iterations, but it's not final. This should be considered a draft product. We're not publicly distributing it at this point, but we need your comments, your notes, your ideas, your experiences with it, and none of what you give me will be released publicly. We are testing, refining before a public release in 4 to 6 months. We'll be talking about it in some detail at the upcoming League of California Cities annual conference. So there'll be more awareness of it at that point, and we want to make sure that you are prepared as possible as this gets to roll out as well. So this is the analytical tool, but we don't envision or advise that you or anyone else would just run with the numbers and plop it in raw data on your city council agenda at some point. You will need to have a wraparound staff report to explain the data and the findings. You'll need to go through a communication strategy of some sort to think about how you're going to roll this out, and that's not something we're going to get into today. So that's for further discussion. So why do you need this? Well, a couple of things. One, to add credibility to your fiscal evaluation. This is because this is an outside tool to look at, to identify areas to improve, to act to remedy those problems before they get worse or unmanageable too, perhaps. Avoid being blindsided by problems, to be prepared for questions from council members, council candidates, citizens, media, even a new city manager that comes on board. What's going on here? To help others, labor associations, taxpayers, and other interested parties also understand your financial position and have some credibility with what you're telling them. Let's first, I want to ask Ron if you have any further comments about the importance of this.
Mike, I think you've hit all the major items. I guess the only thing I would add is in terms of working with your community and your labor organizations, I think by having this available to you, it puts you in a stronger negotiating position to hold down some of your costs, especially when you're trying to fund longer-term commitments. So again, I view this as a tool to be used as part of the negotiating process.
We hope it'll be helpful to you in that, yeah. So let's talk about solvency, defining municipal health, in particular solvency. We can look at this at several different levels. The first level of solvency could be defined as cash solvency, and that's your ability to meet your immediate financial obligations over the next 30 to 60 days, making payroll, being able to pay your bills. The second level is whether you're able to meet your financial obligations over a full budget year, known as budgetary solvency. Are you matching your budget and meeting up with a balanced budget over time, over the course of a year? But obviously that's just a very short horizon there with those first couple. So long-run solvency is really the ability to meet your financial obligations into the future. This gets more into sustainability. Can we manage to pay our bills over the long run given the increases in costs, given our current level of services? And that there is an important stipulation, given our particular level of service. It could be that you have an organization that's able to be stable and pay your bills over time, financially able to be sustainable, but that you're carrying a level of service level that is really well below the desired level of the community, or even really inadequate to provide for sufficient public safety and services. That's what we would call service level solvency. The focus of this is really all four of these levels, but primarily the first three. And then in the 13th indicator, we'll start talking about service level solvency as well. You have an opportunity to address your adequacy there. We'll get into that a little bit more as we roll on here. So developing the tool. We looked at a number of other tools in looking at this, because there has been a long history of municipal finance health evaluation tools. There's some new ones that are out there even now. But we looked at some of the venerable programs. One of the ones that's talked about a lot has been around for several decades, and it's a very thorough, very lengthy fiscal trends monitoring system. Has 11 different factors and 42 different indicators. We wanted to really hone in on the particular necessary, particularly vital indicators, and not have folks running off to do a lot of measurements that were really not directly and clearly indicators of immediate fiscal health. You know, sort of the surrounding issues about per capita revenues or the health of the local economy and those kind of things. Those are sort of surrounding issues, but we want to get to the sort of the meat of the matter and cut to the chase here, as it were. So that was our intent, to really focus on the key elements, and also to look at the experience of that we've had with the particularly troubled cities, with Vallejo, with Stockton, with other cities that have been going through financial trouble. We did a number of interviews and had some really fine input from people that have been involved in those particular situations to give us some sense of, well, would these other tools have been useful in identifying or anticipating the problems that we had here? And if not, which was the case in most cases, they wouldn't have been really, what kinds of indicators or what kinds of questions should we have been asking that may have better anticipated the problems that those cities had. So that's the kind of aim we have here, and we've therefore sort of honed in on some key indicators, we think, and added some in that maybe haven't been seen before in many of these municipal fiscal tools that we think are very valuable.
Mike, maybe I can jump in here.
Yes,
I think the benefit that this system brings is it's effective yet fairly simple, and the information that you have to gather to utilize it is rather limited. It's not extensive. So I think you've got a very useful, effective tool that isn't going to kill you on investing resources to make the thing work and get some value out of it.
Yeah.
Thanks, Michael.
Absolutely. Now, having said that, this is not a simple thing that you can simply throw in a few numbers from your CAF or your budget to be able to produce, as you'll see. It's going to take some analysis. It's going to take some forecasting. It's going to take some digging into the numbers that you've reported to really refine and pull out things to see what the nub is beneath those numbers. And to that end, you're going to need a team that's not just your accounting staff. It's going to have to be a multiple disciplinary team, folks that can do revenue estimating, expenditure projections, that can read debt schedules and know how to use the numbers from those, that can get into the accounting stuff. And also, you'll probably need the assistance of your attorney or legal advice to be able to get into your contracts and legal documents to really do an assessment of what kind of obligations you have to continue, what kind of commitments and obligations you have. That's perhaps one of the more useful things of this exercise, is to get a sense. People who have gone through it already have found that in doing some analysis of these things, they've discovered elements about their obligations, for better or for worse, that they hadn't really understood before, and taken a close look at them. So that's a very helpful exercise, we hope. Yeah.
Okay, we're off to a poll here. So one of the strategic objectives that CSMFO has is to really have these webinars be something that you can use across your organization within finance and also beyond. And finance can be a leader in the organization with general management and others. So we want to see the degree to which that objective has been accomplished by you drawing together additional people into your group. And we also have post-webinar discussion questions that are available in the agenda packets so that you can prompt some discussion about how to apply these ideas in your organization. So we're going to give just a moment for that, and while we are, I'm going to check to see if anybody has any immediate questions yet. It doesn't appear that they do, so I think we're tracking on that score. And again, I would highlight that at the beginning of this material, there is a direct link to the PDF and to the Excel spreadsheets, the tools that actually run these different components that you're going to be seeing from Michael in the course of this. So he's going to be describing that. That'll be available to you on the website, so you don't have to rush to track that down, but it will be available after the session. So we're going to take a look now and see what the results are of this poll. And we can see that about 3/4 of you are there on your own, another quarter are in some small groups, so we're glad that you're all participating in today's session. So Michael, please carry us forward.
Yeah, the content and the specific tool that we're talking about here is available in two forms, an Excel version and a PDF version. You'll probably really want to do your number crunching with the Excel version, but the PDF version is really there for its ease of printing and presentation. Once you've generated all the numbers and gone through all the calculations that are much easier, of course, to do in Excel, you'll be able to put those in the PDF version. It's easier to print out and see. The Excel file contains sections and sheets. It's interactive. There's a cover contents sheet that has hot links to different sections. And data that's entered into the beige fields then populates and calculates into others. So you'll hopefully find that that interactive feature is helpful to you. The PDF file has form fields, limited in its interactive features, but form fields there for you to input the data as you've calculated it over in the Excel version. So let's get into taking a look at what's already here. The basic structure of the document, and if you're online, go to the data gathering tab if you have already downloaded the file in Excel, and you're following along with this. If you have that already done, you might want to fill in your city name and fund. In the data gathering tab, that's where you really do data input. And the next tab then, that disappeared, where'd we go? The next tab then is the indicators. So the data gathering tab really populates the indicators. Yeah, I see. I should probably use that arrow, Ron. Yeah. Don, yes. Oh, so the indicators. Then that's where in the Indicators tab, it'll take that data that you've input, and in that Indicators tab, you'll then also do some assessment based on the data, do some evaluation and scoring. You'll see what we mean as we get into this. And then the scoring that you've done in the Indicators tab will populate out to the checklist and summary, which are really sort of a high list levels for your summary purposes and for sort of answering and asking the key questions. That's the basic format. And here's the sort of the summary sheet, the checklist of the 13 different indicators. We're going to get into some of this in some detail at this point. The primary one we're going to start with is talking about this recurring general fund operating deficits. Perhaps this is the most important and most telling indicator. It's also the one that you're going to find probably spending the most time evaluating because it's not just a simple question.
Okay, we're going to get a quick read from the audience about, now that you've heard a very brief overview of the approach that's with this California Municipal Fiscal Health Diagnostic tool. Interested in learning from the audience, what are some of the tools that people currently use, just so that we can calibrate what it is that people look at and how they use them in order to see how this tool is adding incremental value. And again, we'll take a look at any questions that people send in along the way. We don't have, let's see if we have a question. Oh, we just had some questions here from people about, again, how do you access these tools? These tools are identified in the email that went out on the email list in terms of the website locations. They're listed in the PDF that's on the website. They're in multiple locations. You'll get a follow-up email when the recording is available that'll have that in there. So there's a variety of things that you'll be seeing with this information as we go along. And some people are asking, where do you get the time to use this diagnostic tool? So that's an interesting question. Mm-hmm. What are you finding as, from your experience thus far in terms of how long it's taking people to use this tool?
Well, it depends on the condition of the information that you've got, but it's going to take a substantial amount of time. It could take a week or two and a multiple disciplinary team, and we do some digging and some analysis that is not stuff that's readily available. We anticipate that some folks may want to hire outside assistance to do that, that they may not have the resources in-house to be able to do it by themselves. And we hope to be able to provide some teams or to recommend some teams that could be able to do that as we get down the road here.
Okay, so you'll be addressing that a little bit later.
Yeah, let me just jump in. I think it depends a lot, too, on the sophistication of your in-house team. If you have a fairly sophisticated in-house team who not only understands the numbers but understands the significance of the numbers, I think the time that's involved can be considerably less. So it just depends. But as you said, if you need the help, definitely you ought to get it. But if you do have the capacity to do it internally, you might be able to do it a little quicker than, say, a week.
Mm-hmm.
Okay. And Michael, do you have any quick comment about what you've seen as the results here from the poll of what people are using currently and how what you're proposing complements or builds on that?
Well, it's hard. I mean, it's useful, obviously, to look at projections and financial models, and I'm gratified to see that so many of you are already doing that sort of financial planning level and looking into the future. And so for those of you who are doing that to a reasonably sophisticated level, you'll find probably that this tool isn't as difficult. For others, it will nudge you into having to do some extra practices that you may find very useful and want to continue on into the future.
So some of these survey results here are indicating that people may have a lot of the raw material they need to put into this tool, perhaps at hand from projections and other tools that they're already using.
It could be. Mm-hmm.
Okay.
Yeah.
All right. So please carry us forward.
Yeah, let's take a look now at that first indicator we were talking about as recurring deficits. And if you've got the tool up with you, we're going to be looking kind of really right now at under the Indicators tab. The issue of recurring deficits, we're going to peel back several layers. The first sort of look at whether an agency has recurring deficits, one might simply go to the CAFR and simply look at the gross annual deficit surplus as a percent of revenues, just looking at current revenues in relation to current expenditures. For most of you, of course, that's not going to tell a whole lot. Even if you do projections on into the future, that might give you some indication, but there's a whole lot going on behind those numbers, as I'm sure you know. So a more useful measure would be to go beyond those numbers and take a look at net operating revenues, net operating expenditures, which take into account transfers as well, and then take out temporary revenues. So we're going to talk about in some detail in a moment what that means. But there's even a further measure, and that is, of course, that there are additional costs and liabilities that are not even budgeted. So if we take into account unbudgeted current liabilities, that's going to tell another picture, and one that's perhaps very telling into the future for many of us. So let's take a look at this measure a bit, and in order to fill out the data, you're going to need to get into that worksheet. This is back in the data gathering area, and this involves going first to your CAFR primarily and looking at gross revenues, looking at transfers in, and then taking a look at what your revenues restricted to capital improvements are. So now we want to get into some of these temporary revenues that are going to be taken out in the different levels of this analysis. And you want to look at revenues that are restricted to special purposes as opposed to general purposes. We're going to take those out. We're going to take out the sister of that on the expenditure side, of course. So then you're going to come up with a computation of net operating revenues. The worksheet should do that for you based on what you've input. And then in the following, so here we go. I'm sorry, I'm a little behind on my clicking. Here we go. So you're going to see revenues restricted to capital improvements and revenues legally restricted to special purposes. You're going to fill those in and do some forecasting. We'll talk about forecasting in a moment, and that'll give you your net operating revenues. It's computed in the worksheet. Then in the, as well in the worksheet, you'll be looking at temporary revenues. So looking at, then this involves getting into the content of your revenues in some level of analysis that may not be readily available in the CAFR or anything else. So you have to look behind what is really in those revenues that cannot be counted on into the future. So looking at land sales, one-time transfers, and those sorts of things and taking them out. Let me take a moment and talk about forecasting. There is an old story about a physicist, a chemist, and an economist who were stranded on a desert island. And they're stranded there, but they do have a can of beans. And the physicist says, well, you know, if we just go up to the cliff up there and we drop it from the top of the cliff, that may open the can. I've done some calculations, and physics say that I think it might actually open the can. And the chemist says, well, I really think you haven't taken into account the issue of chemical composition here. And if we heated up the can before we did that, that would actually improve the odds that we would be able to get that can open. And the economist looks at them both and says, you know, it would be a whole lot easier if we simply do this. Assume a can opener. So this is something we don't want to do. We don't want to simply make assumptions that may not be real. That's the point of that story. So we're going to look in your forecasting and in the first and foremost at projections that are based on current tax rates, current allocations, and current laws. You should not be presuming that your voters or the legislature will increase or alter the current tax base, at least in this base analysis. If you want to do a secondary analysis, a sensitivity analysis to see how that might change things, of course that would make sense. But for the first base level analysis, you want to assume current realities on into the future and current rate levels. It is legit, however, to assume that your levels of fees are going to be increased consistent with your existing city policy. So that's reasonable. You should not assume any one-time grant revenues off into the future. We're talking about ongoing sustainable revenues and expenditures. You want to be looking at employee compensation packages essentially based on current contractor policy, including anticipated merit increases and reasonable assumptions off into the future years. You should anticipate reasonable changes in staffing, including growth and turnover, and other expenses necessary to maintain the current level of service, and changes in staffing that are needed to operate any new services or new facilities that are expected, already programmed in, to be completed and operational. It's reasonable to include those in this analysis as well if you've already built the facilities and are anticipating those things to come online. So revenue forecasting, and this can get challenging. Hopefully you have somebody that can give you some help with this. Some of your revenue advisors, some of you use consultants that can be very helpful with this. You want to look at the individual sources separately, not in a big bunch, kind of whittle them down to the underlying elements, paying most attention to those that represent the greatest share of the budget. So you're going to be taking a close look certainly at sales tax, certainly at property tax revenues, and probably you're going to get into your other major revenue sources if you have utility user taxes and hotel taxes that are significant. You're going to spend a little time looking at those in some detail. But for minor revenues, particularly those with little volatility, a simple approach will suffice. It's not necessary to get into a whole lot of detail on those if they're not that significant. Simple approaches meaning reasonable sort of trend projections based on history. But you need to, as you're getting into this, understand the roots of the revenue. What's the base? Where's this revenue coming from? What's the rate, and how are these things changing? What's driving the base? Where's our economy going? What are the exemptions? What kind of collections issues are at hand? And again, your revenue consultants may be very helpful in getting into this. On the expenditure side, doing projections, of course, most critically involves looking at the labor side, because labor in most cities is 70–80% of a general fund. Now, you have contract cities out there where it's a different story, but behind those contracts, we've got labor issues as well. So you're going to have to take a look at your contracted agencies and have some discussion about them, where they see the contract going in future years. But in order to really address the cost of labor into the future, it's most helpful to have a payroll model to view long-term costs. And many of you have this because it's a very important tool in labor negotiations and financial planning. But a good quality payroll model that takes a look at staffing, turnover, estimated pension and medical costs on a 5 years or more range is very important. And then you're going to want to take a look at these other elements as well, service contracts, materials and supplies and things. And for these kinds of things, a basic trend analysis or cost of living adjustment at roughly inflation rate, which is about 2% roughly at the current time projected in the near future, that's reasonable to use for these kinds of costs. And for debt service, you want to take a close look at your debt schedules for projections, what you've got planned for debt service into the future. So now to expenditures. In order to get to net operating expenditures, we're back to the data gathering tab now. You'll see the basic components there where you'll first fill in gross current expenditures. You'll be looking at estimating those expenditures as they go out. You'll add in transfers out, and you'll take out one-time expenditures such as for capital project expenditures. And so you'll get down to a true net operating expenditures, including salaries, debt service, other expenditures, service and supplies, all these key elements. We want to get then also into this issue of unbudgeted current liabilities, very important element. So you're going to be looking at the best information you have about your unbudgeted actually required contributions to your other retirement benefits and pension systems. Unbudgeted earned leave cash outs if you haven't budgeted for those things. Any maintenance or replacement costs of vehicles or technologies, buildings and streets that may not have been budgeted on a thorough replacement schedule. So those should all be included and put into the worksheet there. These will then roll up into the indicators tab that looks something like this. The numbers will compute over, and you'll see those different elements of a deficit surplus. The key one being that third one. But this provides, all this information provides to you data with which to make an assessment. And basically that assessment is, are we looking at persistent and increasing deficits over the years that really presents a very serious warning issue to us? Or Is this something we've had some trouble with? There's some deficits there, but they're infrequent or relatively marginal compared to fund balance. Or we have a reasonable plan for bringing this into balance. That would be, we've had some difficulty, but we've got it under a reasonable plan to deal with it. That'd be a yellow assessment. A green thing would be, well, we're in super shape here, green assessment. We've gone to these color kinds of codes to give you some latitude because each of your situations is different. And you need to be able to tell your own story and make your own assessment based on your particular situations, we feel. So we, rather than try to give you some sort of a numeric rating based on some calculation here that we felt could be easily false, and we sort of started off with that and ran into a number of problems with it, this gives you some flexibility to do a self-assessment here. You should be real with this, but it gives you the latitude to make your own assessment of their situation.
Mike, if I can just jump in here a second. I guess in viewing this, you kind of hit the nail on the head in terms of how big of a deficit are really we talking about in terms of percentage of your total budget, in terms of percentage of revenue and expenditure, and in fact, is it moving in the right direction, and or do you have a plan to close that deficit? And then probably most importantly, has the council and, in this case, the city manager bought into that plan, and are they getting support from the city council to close that deficit? So to me, this is critical, and it has to do with both the having the numbers and the ability to present it well, but also having buy-in from the elected officials in terms of long-term fiscal sustainability, and to do an honest job of how you represent some of your long-term costs, both for the ARC on pension and for retired medical benefits. Thanks, Mike.
Yeah, absolutely. And this is the very critical indicator, the first one here. We're going to roll on to the second one now.
Comment, I'm seeing a number of questions from people. I think some people are trying desperately to look at the tool, do the tool, listen to you, track the webinar, et cetera. And I think if I understood your purpose here correctly, Michael, you're really giving this webinar as an overview to the tool, with then the idea that people could burrow into the tool, having an overall understanding of how to do it, and they might even want to have the Excel spreadsheet, you know, on one hand, and sort of look through the details of this presentation on the other when they're actually going about putting things together in final form. Would that be fair? Because I think otherwise some people are getting a little frustrated. How do I keep up? How do I find this Excel spreadsheet? How do I fill it in? How do I stay up to speed with Michael? I don't think that's your intent here.
Yeah, I mean, it would be, our intent was, and I'm sorry if we didn't communicate it helpfully to you, is to be able to have that on hand as we go through this. But if you don't, I wouldn't stress about it. Just follow along as best you can here. You're going to have a PDF version of this that you can go back to once you have downloaded the tool, and you can, again, go through this. You could even listen to this on a whole recording online again in the future. So I wouldn't spend a lot of time trying to worry about downloading it now if you haven't done it already.
Okay. Thank you.
So let's go on to talking about the second indicator, which is reserves, another very important element. Reserves, of course, can be relied upon to cover financial, cannot be relied upon to cover financial shortfalls that are more than temporary. But so taking a look at one's reserves and where they are going is an important assessment. But of course, you might have a downward trend during a difficult time, or you might have such a substantial reserve that even a downward trend doesn't really threaten it in the long run. So there's a lot of a little assessment that can be done here. And those of you that are, particularly those of you that are accountants and get into the reporting, know that there are various, you budgeteers as well, know that there are various components of fund balance, various elements of reserves. And what we really want to focus on here is what is unreserved, what is flexible and available. So we're going to look at total fund balance and take out any non-spendable, restricted, and committed fund balance. Non-spendable, restricted obviously go out very clearly under the definitions that we have in our reporting guidelines. But committed is really one that you're going to want to take a close look at, because for many of you, there are things in the committed category that may actually be relatively flexible. It may be that simply a council decision, a resolution, a change in an ordinance or something could really free up that revenue. It's not as committed as you may have, as maybe other resources. So that's the sort of one waffle area, gray area. And you may want to take a look at the components that you've included and committed and see if those are truly actually unreserved, and include those, not include those in your committed for these purposes, not include those in non-spendable elements. So you're then going to want to do projections in this as well, and you'll come up with the long-term look at it, and it'll roll up into the indicators tab showing here. And similarly to number 1, you'll make a rating. You'll take a look at whether this is something of concern. We've got persistently and substantially, or is decreasing below 8%. Other folks, you know, the GFOA standard is really more like 15 or 16%, several months. But in terms of a red warning level, we're saying 8% here. That's a rough standard. It could be, you know, as you get into the issue of reserves, there's a lot of factors to consider. And GFOA has an excellent tool as well to look at reserve levels and what might be sufficient for you based on your particular risk factors. So you ought to take into account your particular situation and your risk factors. But generally speaking, as a general guideline, we've thrown in the 8% here. That's not a hard line. And you can assess your own situation when you make this assessment.
Mike, can I just jump in there a second? I guess one thing to follow through on what you just said, I guess as the economy and rates of return on investments get a little more unpredictable, I would just suggest that number may even need to increase a little bit. And the second point I would make is for negotiating purposes, obviously you want to look real hard at what's committed and how it's committed, and to try to get things maybe committed that eventually could be uncommitted and become part of an unassigned category. But for negotiating purposes, it probably helps you a lot more if some of those revenues are committed, so that you don't end up drawing down any reserves you have as part of the negotiating process. So just something else to think about.
Yeah, good insights. Yeah. So let's move on to number 3. This is liquidity. This goes to the issue really of cash solvency, of course, and it's the simple ratio, what sometimes folks call a quick ratio, much like that, cash and short-term investments compared to current liabilities. This is critical, of course, looking at whether you've got the money to pay your bills in the short run, and can be a really important issue. We spend some time here talking about the issue of pooled cash because it really comes up in this issue. Pooled cash can be a dangerous zone because it tends to it makes it easy to spend cash that isn't yours technically. If you're the general fund, you're spending cash in many cases in the short run that isn't yours, that has to be paid back. It's a common practice, internal borrowing for cash flow purposes. But you have to keep in mind the general fund must repay those advances by the end of the fiscal year. We have this thing called the debt limit, which really requires in the Constitution that no county, city, town, township, all you local governments out there, shall incur any indebtedness or liability for any purpose exceeding any year the income and revenue provided in that year without 2/3 vote of the public entity. So debt that extends beyond a year requires voter approval, in fact 2/3 voter approval. So you have to be very careful about this. This is a place where folks get into a lot of trouble getting a little too loose with pooled cash. And we'll move on to the next one, which is liquidity. A little bit back to liquidity again. So in the data gathering tab, you're going to fill out your basic components here of liquidity: cash and short-term investments, current liabilities. You want to include advances due to other funds, including internal funds, from pooled cash and transactions or borrowing. I would treat, this question has come up whether you should treat the governmental accounting group as in its entirety in this. I would take that off, in my view. I think it's better to, as much as possible, whittle down and focus particularly on just the general fund and take those internal service funds and related funds and really treat those differently. You have to deal with the transfers to and from those. That's part of the assessment about whether those are sustainable over the long term, but you really treat those as separate operations that are operating from a transfer standpoint. Now, keep in mind when we're talking about transfers, a little backtrack note on transfers here, it's reasonable that we have certain enterprises or certain activities that may be subsidized with transfers from the general fund over time. We're going to talk about this in a moment as well. You may have a recreation fund, for example. I don't think I've ever seen a city that fully covers its recreations costs with fees. It needs to be supported with tax dollars. Probably, if you set it up as a separate fund, that would be a transfer from the general fund to support that. Perfectly reasonable. The question is this in a trend situation that is not sustainable? If those fees or the costs on those areas because of labor costs or whatever are increasing at a rate that's not sustainable, that the transfers are going to be get out of hand. So that's really a question. So these are the components then of liquidity. Back on liquidity. And these will then roll up, as in the other factors, into the indicators tab, and you'll make a rating and assessment there based on the data that comes up.
Mike, just one more comment there, too. This is where both the city manager and the department finance director can come under a lot of pressure, because sometimes you can get put in a situation where you're asked to recommend a budget where the numbers at the end of the budget year don't reconcile on a cash basis. And as you've indicated, legally you can't do that. But sometimes you get political pressure. I faced that in the city I've been in, where a lot of pressure to get an approved budget there, and nobody's taking a look at the cash, and you find out that you don't have enough cash in the general fund to cover all the expenditures that you budgeted in the general fund. So I think your point's well taken there, that finance directors and city managers need to be careful and just flat refuse to make a budget recommendation that doesn't balance out the cash at the end of the fiscal year.
Yeah, absolutely. And we hope that this will, one of the virtues we hope of this tool will be to provide you, having gone through this sort of exercise, it's been recommended and tested by the League of California Cities, that provides you with sort of an outside source and driver to come up with those numbers and present them and use them. So number 4 is then fixed costs and labor costs. And this goes to the issue of flexibility. One of the problems that we've seen in the cities that have gotten into particular trouble, Stockton, Vallejo, San Bernardino, and others, has been it's been the sort of convergence of having to make severe reductions, which many cities have done, but in those particular cities, that's been sort of met on the other side and on a collision course with this issue of flexibility. Does the city have the ability to make the reductions that are necessary? So the question here, the first issue when we get into this flexibility question, gets in the issue of fixed costs. And this is going to take some analysis. This is where, when you're looking at contracts and those kinds of things, you're going to have to probably get some assistance from your legal teams. Taking a look at these contractual agreements to see how much flexibility you have to reduce costs if you got into a tough situation. It might be that you don't have a whole lot of flexibility at all. But these are some of the elements you want to take a look at in terms of fixed costs. It's a considerable list here, but it's a very important list.
Again, Mike, here's a situation where if you're a finance director or a city manager and you're picking up a major portion of the employees' retirement costs, plus a major or all of their health care costs, both for regular employees and retired employees, you can pretty well bet that your costs, if you do nothing, just renew the same contract that you had maybe the year before, are going up on an average of about 5%. Here in California. So those are the kind of things you really need to think about when you're looking at long-term fiscal health and sustainability.
Yeah, excellent. So this, like the other factors, the data that you put in on this in the data gathering tab will roll up into the indicators section, and then you'll be presented with the data to be able to make an assessment. Again, the number here we said, is this increasing over 80%? That's a rule of thumb. You're certainly left to make an assessment based on your own particular view of things and situation. Okay, number 5, we get into this issue of general fund subsidy of other funds. And I made some reference to this earlier. In many cases, general fund subsidy of other funds can be quite rational and legitimate. In other cases, these subsidies can be quite a problem if they're increasing or if there's a lack of flexibility to be able to make reductions where it's necessary because there's such a dependence upon these particular transfers. Once again, you'll pick the input of this data into the data gathering tab that'll roll up into the indicators tab, and you'll make an assessment. We've given you sort of a guideline, a warning signal of perhaps 5% and increasing, but again, you have to take a look at what the situation is and make your own assessment here.
Michael, before we go on to the next one, we've had a number of questions accumulated, and so that we don't have them all pile up at the end, let's take a few minutes. I think that works with your planned pacing here to address a few of those and see what can be done to help people out. The first one is, do you have a standard for personnel costs as a percent of expenditures in the general fund? Is that part of what you're offering, or do you have some guidance about that or typical practices that you've seen?
There's so much variation in different cities because of the differences in what different cities are responsible for. Some are full service, some are not full service, some are contract cities. Some do components on contracts, some don't. We haven't really come up with, I wouldn't say there's a standard out there. I mean, you can certainly look at some of the really general rules of thumb, but I don't think those are particularly useful. I really think that in your own particular situation, you have to take a look and see if what you're doing is reasonable. Even in the Vallejo situation, I've told this story before. I used to get questions from media all the time. Well, 80% of Vallejo's general fund was spent on police and fire services, and we're talking about departments as opposed to labor versus other spending categories. But I think the point's the same. 80% certainly does seem high, and that would lead you to ask some questions. It doesn't necessarily mean de facto it's a problem, though. It leads you to ask more questions. Say, wow, that's really high. That's not typical. That's higher than a normal, which might be more like 2/3 in a general fund. And so it should lead you to ask some more questions and be concerned, but it doesn't on its face necessarily it shouldn't lead you to conclude right then and there that there is a problem.
Okay. Let's take a look at another question here. We've got a number of them, so we want to punch through them here.
Yeah.
Do you treat OPEBs as a fixed cost in your model tool?
Yes, I think we do. Yeah.
Okay. And then does the law about pooled cash include enterprise funds that have a pooled cash deficit and are basically borrowing from the general fund?
Say again, John.
This is asking the whole question about the law that you cited with regard to pooled cash.
Yes.
And wondering whether that pooled cash includes enterprise funds, and the person was asking in particular that I guess they have a situation where enterprise funds have a pooled cash deficit that they're basically borrowing from the general fund.
That's a good question. It's a legal question. I'm not an attorney, but my understanding of that constitutional provision is it has to do with primarily with taxes and the approval of taxes. So I don't think that applies to enterprise funds, but I would have to ask legal counsel.
But I would be looking to reconcile that, I guess would be my comment. I would be looking to reconcile that at the, at the end of the fiscal year. You don't want that deficit to go on without accounting for it.
Yeah, it's still bad practice, even if
Right.
it's not legal, if it's legal. Yeah.
So then there's just a question here. Some people feel passionately about having net operating revenues in the denominator for the indicator. Why use expenditures? In other words, why did you pick the particular ratio that you did back in?
Well, that's sort of a judgment call. One could go either way. If you feel a percentage of total revenues, that's fine. It's not a big, it's not that important, I think, a distinction.
Okay. And then there's a question here about the treatment of capital expenditures. when talking about capital, at what level, if you're truly capturing unfunded infrastructure needs, that could be huge.
Mm-hmm.
So there's a lot of discretion then about what your capital expenditures are and what they maybe need to be to sustain the infrastructure of the agency. How do you deal with that potentially large variability in estimate of capital expenditures?
Yeah, that's a very good question. I think, ultimately we want to look at the fully sustainable, fully funded financial plan for your city to be sustainable and healthy in the long run, and that includes replacement schedules at the level of service that the community needs. So that could involve putting in some costs there that you really haven't planned on yet, and they're going to be a big wake-up. But you may want to look, I think, for purposes of contrast and illustration, what your current level of spending, what your current level of service and replacement is, and sort of start there and see what difference it makes when you bring in the fully funded replacement schedules.
Can I just add to that? I would just say, when you look at everything, I think that's important, give you a real feeling for where you are from both an OPEB point of view, which would impact many cities greatly if they had retired medical fully funded, and when you look at how you handle capital. And I guess I would just say how you present this information is probably the art of this tool versus the actual numbers that are in this tool. Because I think if you presented in the full case scenario, I think probably most cities in the state would not look very good if you had to do a full actuarial analysis of all your infrastructure needs, all your OPEB needs, put it on a spreadsheet, and then present it. So I would argue that there's some art in how this information is presented.
Definitely. And, a lot of you, I'm sure, are looking at this and going, whoa, this is going to be some warning signs for us, or, we really include all these numbers. It's going to be tough, and that doesn't surprise me. I think a lot of us are in some trouble, and we need to really face up to what these situations are and help other people understand that. That's really the purpose of this. So,
okay.
Yes.
Just one last question here. We'll move on. And that is, people are noticing that you're going back to 2011, 2012 for past data, and they're wondering, did you give thought to showing more prior years, or what guidance do you have to offer to users of this tool with regard to how they develop a sense of trend?
Right, and this kind of goes to the question of timing on this. This is, really, in order to get good current year data, you're probably really going to be doing this exercise in January or February, once you've got some mid-year information and can have some reasonable estimates about your current year, your books, and for the prior year, your CAFRs completed for the prior year. That's probably the most ideal timing for really doing this analysis and pulling up these numbers. But the years fields in this tool, to sort of get to that question, are open. We fully anticipate, once we get this more finalized, and it's always going to be a process of work in progress, that in subsequent years you'll be able to alter those years and do it for a different set. So we're not hard fixed on those particular years.
Great. Well, thanks, Michael and Ron, for giving our audience a chance to get caught up with you on the questions on their mind. Please proceed.
Yeah, so one of the critical issues as I mentioned, in the cities that were having difficulties and having to go into bankruptcy were issues of legal commitments, and in particular charter provisions and those kind of things that really restricted the council's authority. So this gets into, again, an analysis with the assistance of your legal staff, looking at, do you have binding arbitration in your charter? You have a labor agreement that contains that. Do you have formulas requiring minimum employee compensation or staffing? Is the general fund pledged to support for public securities or for a non-general fund debt? Are there restrictions on contracting out or other voter-approved, or do you have a voter-approved tax that's expiring that's going to create a further impact? So these kinds of restrictions can be very important, and very important to look at what's there. So this is the
Mike, again, to comment on that, I think, you know, if your council and the city manager, finance director is really restricted in these categories, in my mind, these can lead you quicker to bankruptcy probably than many of the other situations that you can face, because it really limits the flexibility a city council and a city manager has to address major financial concerns in the city.
Yeah, absolutely. And this is one of the areas I would say that prior tools, other tools that are being used and discussed really don't take into account sufficiently, I think, based on what we've seen in the cities that have gotten into trouble. This was a very important factor, and it's probably not, hasn't been previously recognized as important as it is. Then we get into some more issues about practices, really, that one may have gotten into, and if these could be helpful in sort of balancing budget in the short run, but if they're being used excessively and you're going to have to get into this much more into the future in an unsustainable way, these are big warning signs. The use of temporary funds, selling assets, drawing down reserves consistently, borrowing, internal borrowing, amounts owed to pool cash, deferring employee compensation costs, pensions, liabilities. These are all important issues to take into account and look at. Again, these can be helpful tools and not problematic tools if used prudently and in a limited fashion. What we're talking about here is relying upon these consistently and in a long-term fashion, where you really not simply relying on these for a temporary downturn situation, but more in a long-term situation that's not sustainable. We get into more of these with question number 11, the issue of funding operating costs with non-recurring development revenues. This was has been a situation, was a problem, one of the problems, contributing problems in Vallejo, and has been a problem in a number of cities. It's a way to get really caught when there's a downturn, when you're consistently over time paying for operating costs with development revenues, and depending upon future growth to fund services to existing parts of your community. There's the issue of timeliness and accuracy of financial reports. Some of you might say, well, what does that have to do with financial soundness? Probably more than anything else, we found looking at cities that have gotten into trouble, there's a very strong correlation with not filing financial reports on time, state controllers' reports being super late on the CAFR, and cities that are getting into trouble. It's just an indicator that there's a problem there. So this is a warning sign as well.
Mike, if I could just jump in again, I'd say with 7, 8, 9, 10, and 11, I'd be real reluctant to use those. I think you've indicated that, but to me those are just danger flags if you're having to use that approach to get a balanced budget.
Yeah, very careful. And then we get to number 13, and this was one that really came up in some of the more recent iterations of the report, because we had the issue where, quite conceivably, a city or an agency could go through this analysis and really say, well, with a few problems, we actually think we have a sustainable situation here, but hey, we're providing a lousy level of service to the community. And so we felt in order to address that, there really needed to be an indicator that looked at the issue of service level solvency. The question of, are your public service levels below the standards in your community? Now, this is something that we could get into a whole nother analysis on, performance measurement and all those kinds of things. And different cities do this in different ways. We thought about whether we should provide some basic indicators of, response times and those kinds of things. But once again, we're leaving this one open for you to be able to take a look and do your own assessment about how you're standing up to your community. If you're going to do this indicator and answer this indicator well and with some information, you will have used, hopefully, some of the performance measurement programs that are out there. There's a good one available from GFOA now. Take a look at these kinds of things so that you can have an informed answer to this question, but it's a really critical one. Ron, do you have some thoughts on that?
Yeah, I was going to say this came out of a discussion when Mike presented this to the city manager's steering committee. And I think what really brought this about is some of you were following the Detroit bankruptcy, you probably noted in that discussion that their response time for Part 1 serious crimes in Detroit had dropped to nearly an hour. So just imagine an hour for Part 1 response times in your community, and is that a legitimate level of service if you're using all your money to support your current operation and really aren't providing service? So I don't think we're to that point in most of our cities in the western part of the country. However, I do think it's something we have to be careful of, because that's the tendency, is to let service fall when you're trying to balance a budget and you have a lot of fixed costs that you can't unload. So that's the challenge I think we face.
Yeah, excellent. So this basically, you'll wrap this up with those 13 measures, and the financial distress checklist in the Excel file has some interactive features in there. It'll actually color code the responses, give you little yellow and red indicators there for these 13 elements. As I said at the outset, you're not going to want to simply present this one-page schedule with the different colors to your city council. This will require some explanation and some discussion of these different elements so they understand the reasoning behind your ratings and why things are not worse, why things are not better in each of these things. So an important element to this will be your staff report that wraps around this. So that concludes the meat of the presentation. We would like to get some feedback from you. As I mentioned at the outset, this is in draft form, and we're continuing to work on it. We'd like to get a sense, as we've already discussed in some of the polling, and we'll continue to talk about, how ready is your organization? What are the barriers that you're going to encounter to taking on this tool, to using it? Number one, to using it, to doing the analysis. Number two, to actually presenting the analysis, perhaps. What kind of outside support will your organization need in order to do that, to carry through the analysis, and then also to get support to bring it forward? How can we more accurately identify your fiscal problems? Are there some issues or indicators that we're leaving out here that we've missed? And how in need of this is your organization? Is this, you think this is going to be helpful or not?
Okay, so we're going to get into some interactive input on this topic, because as finance leaders throughout the state, you have, in our audience, you have an important opportunity to shape the use and direction of this tool. So we're going to be doing two things at once here. We're going to be doing a couple polling questions to get at these topics that Michael has outlined to you, and then we're also going to be picking up the questions that you're sending in. So let's take this first polling question here. In what ways would this diagnostic tool be beneficial for your agency? So tick off as many as you would see to be of value. And while we're giving people an opportunity to respond to that, let's take a look at some of the additional questions that have come in. Just catching up with them. In addition to late filings, would you see restatements as a danger sign? Stockton had $100 million in prior period accounting adjustments in its 2011 CAFR, as an example.
Well, that's one we hadn't really considered. That's probably a good point. Yeah. I'd like to look into that some more.
Okay. So again, if people have questions, or if there's some interest that you've got or suggestion on how to improve this tool, please send it through the question function. We'll be noting that. We also had an observation at the beginning that when you were looking at different levels of solvency, people were just noting that although you didn't adopt the ICMA program, they thought that those different types of solvency were part of the conceptual framework of the ICMA structure. Did you want to comment about that for people who may have been using that tool and wondering about the cross-connect?
Oh, very true. We certainly, while we didn't use the ICMA program in its entirety, we certainly shamelessly borrowed and stole some of the concepts and elements from it, for sure.
Okay. All right. So let's take a look at how people responded to this poll. Share the results and invite both Michael and Ron to comment about this. What people are seeing is the utility of this.
Wow, that's great. It's good to know.
So, Michael, it looks like you hit another home run.
Yeah. Well, this sort of goes right to what we've been hearing from a lot of council members, from the executive board members on the league, mostly elected officials, that there was a real need for this. They want to be empowered to know what questions they should be answered. They don't want to be blindsided. And while asking these questions can be very scary, we've certainly had our share of both council members and managers, and I think even some finance directors say, ooh, this is going to be rough to deal with. They know that this is important medicine. And the issue about rough to deal with, I think, really goes to an issue of how to work this through in a healthy way in your community. And that goes to really talking about a good communication strategy. And that's something else we're going to be exploring with you in the coming months about the best way to roll this out, to work with the community on this.
Ron, do you have some observations about the responses to this survey? And I would just note for people who are wondering, we have about 150 different locations responding, so it's while not a scientific sample of agencies throughout California, it is a pretty broad group of participation in today's webinar. Thoughts and observations you have about what you're seeing in terms of people
I'm encouraged, and I'm very encouraged, and I think it reflects the very competent, thorough work Mike has done in putting this together. Now, having said that, I would caution, I don't know how many city managers we have on the line, but I would caution all the finance directors that we have on the line that while it's a valuable financial tool, how it's handled can be very, very problematic. And what I mean by that is, think about it now. This could become a big issue in your next election, right? Some of the candidates for city council who are running against the incumbents so look at this and say, man, look at your city's almost bankrupt. How come your city council hasn't done anything, about this, beforehand? Why are we reading this now? So again, I think this is what Mike's alluding to, how we handle this and how the management team at the city works to incorporate the city council, inform them, but in a non-threatening manner, and provide it in a working environment with, potential solutions, how we address some of these issues. I think that's going to be the key to using this effectively and not as a bat to beat somebody, either the council or the city manager uses it. I mean, the council uses it a bat over the city manager and finance director. Why haven't you told us about this earlier? So there is some challenge in how you move forward with this in a productive way.
And let's turn in just a moment. I want to make a comment about that, but just tee up Michael, because I know, Michael, you were sharing when this webinar was in preparation, some preliminary thoughts or options about how this might get rolled out and how you might do this at sort of a roll-up-your-sleeves staff level with different agencies. And I'd like you to describe that for the audience in a moment, so maybe they could give you some feedback about that or other ideas they have about how to roll this out. But I think to pick up on Ron's comment, it'd be unfortunate if the very agencies that are most in need of this avoid using the tool because of its potential consequences. So, Michael, some thoughts about what the discussions are that you're having with regard to how to make this a helpful, positive, constructive tool and some options you're looking at along those lines.
Well, as I say, we're just getting into that, and there's certainly PR folks that have particular expertise in this that we're going to want to discuss this with, that are very thoughtful on this. But obviously, you don't want to blindside your city council or your city managers, as Ron was alluding to. You want to be prepared, but you don't want to blindside them on this. So letting them know that this is a concern, that you have this tool, that you're going to want to begin to take a look at this, lets them be prepared to know that that's coming along. That's, I think, one thing that's very important. I would say also keep in mind as we go forward with this, the comment I have is that you don't want to be the person who put off doing this because it was just scary and you didn't want to bite the bullet and you were afraid how was it going to make you look, only to have a new city manager come in and say what has been going on, and they're the one that does this, and then you get thoroughly embarrassed, or for you also to be the one that retires, and then after you leave, this happens, and all this stuff makes you look bad in retrospect. So I think you'd rather be the one that becomes part of the solution.
Okay. So there's a number of comments and questions that are coming along. I want to share those, and again, welcome suggestions from our audience about how to use or not use this tool, or requests about how it's introduced. But there's a comment here that GFOA has also come out with a financial management tool. How does this compare? Are you acquainted with that, and do you have a comment about that?
Well, somewhat. I'm not acquainted enough with it because they want to charge me a lot of money for it. So, the one comparison, I suppose, is we're not charging money for this one, but that doesn't necessarily make it better. I think we've gotten to some particular elements here based on our particular experience in California with the problem cities that are not addressed elsewhere. So generally speaking, I think there's some things here that you won't find in other tools that we do think that are important. Others out of California may not think they're so important. And secondly, that there are some factors we've left out here, certain ratios and things like that we just don't think are necessarily as directly informative as the essential ones that we've included here.
Okay, and just to be clear, because one of the questions came in along these lines, there is no charge for use of this beta version or future versions of this tool. Is that correct?
Correct. Yep, not to members. But actually, I even say that facetiously because members of the CSMFO that are now league members, it's available wide. We're not making any restrictions on it.
Okay.
Don, if I can add to our previous discussion. And I know we're not necessarily here trying to, give Mike more employment, so to speak, but our thinking, at least at the city manager level, was a lot of the work Mike has already done on beta testing this, where he does it with small groups of willing cities, and you do it on a more informal basis where you can start getting some of the information, maybe get one or two elected officials involved in the process in the city and do it in small groups in different areas of the state with professional help, with somebody like Mike Coleman involved, that may be a real good way to start rolling this out and not make it as threatening as your city is the one that's doing it right now, and it's more a part of a beta testing process. So those are some of the ideas that are being kicked around, and certainly I know Chris at the League is interested in any other ideas on ways to roll this out in a non-threatening, very productive manner.
And I would imagine that if you did that where you had a number of agencies working together in that way, it might also enhance the confidence of electeds and the public that, in essence, some of these judgment calls that are required of any tool have been kind of aired and vetted across a group of agencies that maybe confront similar trends and so on in their localized area, and in that way might enhance the perceived value and legitimacy of what goes in the model and what comes out.
Mm-hmm. Yeah.
Okay. So one comment here, you made a comment at the very start that this is applicable for not just cities but also special districts and counties, et cetera. So an observation that people have is that the template refers to city of or city. What about changing this to agency to highlight that it's really appropriate for all public entities?
Yeah, I think actually, well, number one, it is a product of the League of California Cities. There's nothing to limit another agency from using it. And it is focused primarily and in mind with city general funds. But it certainly could be taken to other funds of the city. and look at the health of another fund. You could try to apply this in other places. I haven't really thought that through, but a lot of this is going to be very valid in other funds, and I think certainly other agencies as well. So we'll be interested. I'd be interested to hear what the experience of other agencies is with this, and how it works or doesn't, how the things are different.
Okay. We've got a couple more questions that are coming in. We also have a couple more polling questions to ask you, so there's some important interaction to continue here on this session. Let's just check in on a couple things here. Does the model provide for an agency to estimate savings from operating programs? Since many of us have established that we only spend 96 to 98% of what we budget each year. So people are saying, how do you deal with projected or desired or targeted savings in the model?
Well, I think that's that's usually a part of the overall financial model. If there's savings, that's going to be a part of your trend analysis. It's going somewhere, right? Or you're budgeting for those savings to use those in a subsequent year, right?
Should be covered in the CAFR, Mike, I would think. When you
use
the CAFR numbers, will pick it up in there.
Yeah.
Okay. And then we have another question. How about the use of this tool in comparison of one city to another? Might not be good if they aren't using the same assumptions, specifically about unfunded infrastructure needs. In other words, if there's a certain flexibility in this model, and how do you, compare cities? Did you actually consider that cities might compare with one another based on using this tool, or how do you deal with the fact that different cities might make quite different assumptions about some of those judgment calls?
That's a really excellent question. The motivation for a lot of for this kind of a tool many times is from folks that simply are interested in comparisons. And the problem with that, as you all know who have worked in several different agencies in particular, is that they're different. There's a lot of differences among cities, let alone different types of agencies. Not just in terms of size, but in terms of responsibility, in terms of the particular nature of priorities and what's involved there. So when we get into these comparisons, many times people are led to draw conclusions comparing one city to another, ranking cities and those kinds of things that are just really fallacy. So we really didn't want to enable that sort of thing. And I think, because it's very difficult, because it tends to lead to really erroneous conclusions that are not fair and are way too simplified. So the fact that this is probably difficult to use in comparison from one city to another, and sort of setting one city against another and ranking them, is, we think, inherent in the nature of our business and a good thing.
Yeah, I would say, just maybe trying to say in a few words, that they aren't comparable, and they weren't intended to be. And we don't want it to be used as a bat in one city to bat the other city over the head, saying, see, I'm better than you are. Right. So that's kind of the issue here, because, again, that relates back to the politics of this thing. So, again, it can't be used as a bat over city council members or over city management staff who haven't done it. A perfect example is many cities, if you have retired medical benefits and you aren't actuarially funding those, make some actuarial assumptions on those numbers. Stick those into your budget and see how close to balanced you are. So just how you account for that expenditure, even though you know it's on your book, can affect the outcome of this instrument, which is, again, why that's where the art of using this instrument really comes in, and how you project it, because you may have, and hopefully you're thinking about, what's your plan to handle that retired medical benefit as your expenditure each year has to get higher and higher and higher to fund it if it's not being actuarially funded.
Okay, so we have another polling question here in response to something that would be of great value to Michael and others who are offering this tool to you. They're interested in knowing how ready your organization is to undertake using this diagnostic tool. So please make a choice amongst those options there, and provide some feedback. about what you think. I know some questions have come in from people about, again, where is the tool located? How do I get access to it? And I do note here that for some reason the Granicus connection went down during the course of this, so that those of you that were trying to go to the website may not have had access to the PDF of the PowerPoint and so on at the present time. I'll work with Granicus to get that fixed, and within the next 24 hours, hopefully have that available to you. And you'll be getting an email with the actual links to where you can go to get access to the diagnostic tool, at the Excel spreadsheet, and the PDF form that Michael's been sharing with you. So we'll be covering you there as best we can. So we have this polling question and one more to come up that's going to be an important one, and some additional things to share with you here. So just give you a moment more. We'll close this polling result here and make sure that we have a chance to share these results. So Michael and Ron, some comments and reactions to what you're seeing in the polling results.
Well, it's a mixed bag, isn't it? Yeah.
Mm-hmm.
So some people are all ready to go.
Yeah.
The majority of them all ready to go. Some who feel like, whoa, we got to address some policy or political issues, and a relatively smaller number that'd like to do some local work groups or other approaches. So if you're offering that, you might want to be providing some more explanation of how that would work so that people could understand if that's something that would be helpful to them.
Mm-hmm.
Okay, so let's take a look at a couple other items here. Here's the contact information for Michael and for Ron. Really appreciate the value that they have delivered to CSMFO members and their colleagues in local agencies throughout the state today. Glad that you have been able to be with us and have that benefit. This is where you'll be finding the information. Again, that will come out in an email to you from GoToWebinar at citrixonline.com. That's how this gets communicated to you. We have an automated system for you to get information about the follow-up and other information for this session, and we encourage you to respond to the survey when you complete this session. We have one more question, and we have a couple more things to cover here. Let's just take a look. These are some follow-up questions you might have that you could have some discussion about in your agency to figure out how you'd like to use these ideas and put them into practice for yourself. And then let's go to the final question. And while we're doing the final polling question, we're also going to be responding to questions and comments that have come in right here at the end with regard to this tool and how it might be used. So these are some of the things that this webinar is intended to accomplish. We'd like you to check off as many as you feel were adding value to you in today's session so that we can get a read on how it's fulfilled your interest in the objectives for the session. And while that's going on, we'll just take a few more.
Don, can I add just a quick comment, and that is regarding how to access the tool. You know, there are a number of, I think, 14 divisions of the league here in California, and certainly if a group, one of those divisions, through their city managers and their finance directors, were to request some assistance of Chris and the league, perhaps a group of cities from that division, of how should we say, cities of the willing, would be able to get together, and Mike or a senior staff member might be able to provide some assistance in working through the tool in that area where cities would get ready, and then potentially Mike would come down or someone else would come down and meet with them and help them try to put all the numbers into the tool and get some meaningful information out of it so it could be handled in a low-key way. So that might be an approach if finance directors and city managers wanted to follow through with it on a league divisional level.
Okay, so let's take a look at how this provided value. Clearly, this is a great overview. Thank you, Michael and Ron. And people were convinced about the value of having a preventive diagnostic, and this got them thinking about how to apply this and some opportunity to give you some input. So any quick observations or responses you want to make to that? Michael or Ron?
Good. Good to have feedback. That's great.
Okay. All right. So just in terms of an upcoming webinar, the next one is going to be next Wednesday, September 11th, 1 to 2:30. This is Economic Development, New Strategies and Best Practices, especially relevant for California, given the demise of redevelopment agencies. And we're going to be also pulling in examples of what's best practices elsewhere in the country, so that as California retools, you can be learning how others are approaching this and what would be some useful approaches that you could be applying here. So with that, I want to just give Michael and Ron a moment to provide a closing comment here. I do see from some of the comments coming in that people found this very helpful and they're looking forward to using the tool. So it's great that you were able to provide such value. And Michael, a quick closing comment, and then one as well from Ron. And
yeah, two things I want to emphasize in closing. One is this is a work in progress. Even after we go public with this in some months, we'll be continuing to look at refining it and revising it. So your experiences and your input are going to be very valuable. Second point is that whatever you do send to me in terms of your comments, your experiences, your specific analyses, none of that is public. It's all draft information. It's all confidential.
Okay, thank you so much, Michael, for all your work on this and for your excellent presentation as always. And Ron, thank you for being a commentator. A closing word of advice or perspective for your colleagues.
I'd just like to thank all the people on the phone for the work they do. I think in most cities, counties, special districts, it goes underappreciated. But quite frankly, you're doing God's work. I'll use that term because I think especially over the next 10 years that your work is going to be absolutely critical to maintaining the quality of life for our residents around the state. So please keep up the good work.
Okay, well, thank you very much. And thank you, audience, for participating today, for all your useful questions, ideas, and comments. And we look forward to your participation in future webinars and your feedback on how the CSMFO coaching program and these training programs and webinars can be of use to you in the future. Please respond to the survey. And thanks so much for being with us today.
Thank you, Don.
Thanks.
You're welcome. Goodbye.